Hi, good afternoon, everybody. I hope you enjoy your lunch and also get good investment advice from the presentation in the morning. Time flies. I check my diary. My last seminar with Singapore was the 9th of January. And now we are entering April, the second quarter. So today these are my key discussion points today. I'll review with you the performance of the Hong Kong and China stock market in the first quarter. And then we'll take a look at the China's economy and also share with you our 2021 outlook of the China's economy. Then we'll provide you the index targets in the second quarter. And also, if you're interested in choosing ETF to play on the index, we'll have some ETF picks today. And then last but not least, I'll share with you the stock pick this time round. My apologies for there are some drilling sound in the background because there's some construction work doing, I think, on the upper floor. So I apologize for a little bit of the noise there. Hope you can hear me clearly. Okay. So the first quarter was actually a roller coaster first quarter. The Shanghai Composite Index rallied sharply in the first 2 months, January and February, and hitting a recent high of 3,731 points. And subsequently, there was a sharp correction, correcting back to below 3,400. So up to the end of March, the Shanghai Composite Index was down 0.9% in the first quarter. So it's a roller coaster first quarter. As for the Sunshine Composite Index, it was down 4.5% in the first quarter after hitting index high of 16,293. It corrected to around 13,250 recently, and now it has rebounded to about 14,000. Okay. The Chinex is even more volatile in the first quarter because it's risen very sharply last year, 65% last year, and then continue to rise to a recent high of 3,476, close to 3,500. And then it corrected to around 2,600 recently. Now it was back to around 2,000, between 2007 and 2,800. So in the first quarter, the Chinex was down 7%. Okay. Hang Seng did a bit better than the A share because last year Hang Seng underperformed. So the Hang Seng index also saw a sharp rally in the first 2 months this year. In January and February, the Hang Seng index reached a year high of 31,183. And then the correction saw the index dropping back to around 27,500. Lately, it has rebounded to 28,900, close to 29,000. So in the first quarter, the Hang Seng index was still up 4.2%. Okay, we also take a look at the Hang Seng Tech Index, the technology index. It went up even more in the first 2 months, from around 8,000 points to a high of 11,001 points. So it was up more than 3,000 points in the first 2 months of 2021. A sell-off in the tech stocks in the US also trigger a sell-off in the tech stocks here in Hong Kong. So the index, we saw the index dropping from 11,000 to around 7,600, or back to the the point where it started the rally in early January. So now we are back to square one. And in the first quarter, the Hang Seng Tech Index was down 2.9%. So that was the general view of the major indexes. Okay. China, overview of China's economy. China's economy advanced in January and February, but mixed data underscores uneven nature of recovery. What are more robust? The retail sales and industrial production data in the first 2 months were stronger than expected. However, fixed asset investment growth was lower than expected, while the survey unemployment rate rose during the first 2 months of the year. A lot of people are still out of job. And then also we noticed that there's a sharp increase in the PPI, the Producer Price Index, and too much stimulus in the US. Just this week, Biden has announced the $2.4 trillion stimulus. So going forward, we are a bit worried that this will fuel inflation in the US as well as in China. Okay, just now I mentioned the fixed asset investment was lower than expectation. But we really took the first 2 months in combined 2 months because of the Lunar New Year effect. So we normally will take the first 2 months data together to do a comparison to smoothen or to wipe out the seasonal distortion. So China's fixed asset investment surged 35% year on year. And if compared to, because last year there was a low base because of the COVID-19 pandemic. If we compare the first 2 months this year with the first 2 months in 2019, still fixed asset investment in the first 2 months this year still increased 3.5%. And the 2-year average growth rate of 1.7%, which was a bit low, I would say. But the surge in the first 2 months this year was due to accelerating investment into high-tech industries and social welfare sectors. The chart on the right-hand side shows real estate investment. In the first 2 months, also a big jump. Real estate investment is important because it counts for over 30% of fixed asset investment in China. For the first 2 months, real estate investment increased 38.3% from 2020. And compared to 2019, it increased by 15.7%. And the 2-year average growth was 7.6%. Not bad. That shows real estate investment in China is still rather robust. The property market recovers quickly from the COVID-19 pandemic. So the chart on the left-hand side shows property sales by floor area and by value. Property sales by floor area surged 104.9% year on year in the January-February period, while property sales by value surged even more by 133.4%. If we take the first 2 months to compare with the first 2 months in 2019, property sales were up 23.1% by floor area, which is underpinned by the control of COVID-19 epidemic and overall improving macroeconomy. The chart on the right-hand side is the Real Estate Climate Index. This is an indicator of the confidence among property developers. So you can see that the Real Estate Climate Index currently has risen to a year high of 101.41. Anything above 100 represents that property developers are generally rather optimistic about the outlook. Okay, retail sales also rebounded strongly. in the first 2 months this year, up 33.8%, especially online retail sales surged 32.5% year on year, and online sales of physical products now accounting for more than 20% of total retail sales in China. But in terms of growth rate, if you look at the growth rate from September last year to December, it was slower, more slowly than other the growth rate of other economic data. So retail sales has not yet returned to pre-epidemic level. And we do expect as the macro economy continues to improve, retail sales will return to pre-epidemic level this summer. So in the between the second quarter and the third quarter. Okay. China foreign trade also surges in the January-February period. Exports soared by 60.6%. Oh, very due to strong demand from the trade partners of China, and imports rise by 22% in the first 2 months. So this year, despite the Chinese Lunar New Year holiday and the epidemic, China's foreign trade increased significantly in January and February, thanks to strong external demand and a recovering domestic economy, as well as a low base last year, due to last year the COVID-19 control measures being implemented last year. Okay. As export improves, industrial output also quickens on accelerated manufacturing and mining growth. The rising commodity prices is also positive to also helps mining growth. February industrial output, just take the first 2 months, industrial output in the first 2 months increased by 35.1%. If we take the February figure, just the February figure alone, it grew by 0.9% from January, despite there's a week-long holiday, the Lunar New Year holiday in February. Despite that, February industrial output still managed to grow by 0.69% month on month from January. Because this year, as you may have read in the news, the Chinese government encouraged workers to stay put, discourage them to return home, to travel home. So fewer workers travel home for the holiday this year, helps the growth in industrial output. A lot of the factories can resume production very shortly after the Lunar New Year holiday. Okay, industrial profits also continue to recover rather rapidly. Industrial profits in the first 2 months of 2021 rose 72.1% from the 2019 levels. If we compare to 2020, the yellow line is the revenue growth. The blue line is the profit growth. So profits, industrial profits in the first 2 months this year actually rose by 178.9% compared to 2020. Compared to 2019, was also up 72.1%. So very strong recovery in industrial profits, bringing the 2-year average growth to 31.2%. And the surge is attributable to a combination of factors, such as stabilizing domestic and foreign demand, low basis last year, and just now, and the stay put initiative I mentioned just now over the Lunar New Year. So in factories can have more operating days in February this year, allowing them to make more profits this year. Okay, but this is the more worrying area, that is inflation. China's PPI jumps in the first 2 months this year, adding to global inflation risk. On the consumer inflation level, I think still there's no inflationary pressure being seen. The chart on the left-hand side shows the CPI, Consumer Price Index. The blue line is a year-on-year change. The yellow line is a month-on-month change. So year-on-year, the CPI saw negative growth for 2 months, down 0.3% in January and 0.2% in February, due to the high base effects last year and also lower pork prices. But the PPI rose to 1.7% as producers passed on rising raw material prices. Okay. Now we normally we use PMI for an indicator for future growth. So official PMI signals strong recovery. The chart on the left-hand side shows the official manufacturing PMI after contracting for 3 months, declining for 3 months. The March official manufacturing PMI jumped to 51.9, back to the level in December last year. It rebounded strongly as factories that closed for the Lunar New Year holiday resumed production in late February to meet improving demand. So the purchasing managers become more optimistic about the short-term outlook. Whereas the chart on the left-hand side shows the official non-manufacturing PMI. Wow, it rebounded even more sharply than the manufacturing PMI. It rose to a 4-month high, fueled by rising consumer demand. Okay, but the Caixin China manufacturing PMI shows weaker results. So they are a bit mixed. The official PMI still shows very positive signs of the economic outlook, but the Caixin PMI shows weaker results, especially the manufacturing PMI. Because the Caixin survey focuses on small, private, and export-oriented firms. So the conclusion is that these smaller and private and export-oriented firms may not be as confident as the big cap companies and the state-owned enterprises, which are being surveyed under the official PMI. The Caixin manufacturing PMI dropped to 50.6, the lowest level since April 2020, but it still managed to hold about 50. 50, as long as it's above 50, I think it's still okay, because 50 is the threshold between expansion and contraction. So it shows that the Caixin manufacturing PMI eases a bit in March, but the surface PMI, as you can see from the light blue line here, actually rose to 51.9. So the surface PMI, the non-manufacturing PMI, is still very resilient under this Caixin survey. Okay. As for the monetary policy, China's monetary policy, we don't expect much change. Here, I quote the recent statement from the People's Bank of China to show some of the stance of the central bank. So those statements include the positive effect of China's normal monetary policy stance is emerging, so things are looking good. And stimulus measures implemented by the Federal Reserve over the past year and future policy changes that the US Central Bank has signaled will have limited impact on China's financial markets. Just now, I noticed that some of the audience have raised questions with our Singapore colleague whether the U.S. stimulus package will fuel inflation and what will be the impact on China. But we can see from the comments from the central bank, China Central Bank, they think that this will have very limited impact on China's financial markets and will not impact the monetary policy of the central bank. The next step will be to keep monetary policy steady. There's also a need to keep China's benchmark lending rate for corporate and household loans, the so-called LPR, loan prime rate, at a reasonable level. So in the last 1 year or so, you can see China, the PBOC has been adopting a very neutral kind of monetary policy. There's neither any rate cut nor rate hike. So the LPR, this loan prime rate, has actually remained unchanged for 11 months. So it seems that the central bank is satisfied with the current economic situation and will continue this neutral stance, neutral policy stance in future. So Beijing this year has set an annual growth, economic growth target at about 6% this year. Looks a bit conservative, but there's no specific numerical target, just a range at about 6%. Based on the economic data for the first 2 months, we forecast China will have a very strong first quarter GDP growth. The growth rate may reach between 15 to 20%, which would make its first quarter economy, the expansion, the highest among other major global economies. But subsequently, after the first quarter, GDP growth will likely slow down this year, quarter by quarter. But we expect the full year GDP growth rate will be at 8.1%, much higher than the government's growth target. Okay, yuan. What is our outlook on the yuan? You can see the yuan has been on a relentless advance from above 7 yuan to $1, keep on appreciating to around below 6.4 yuan to $1. But we think this bull run, this rising trend may have reached an interim peak. The yuan may have reached an interim peak against the dollar. The yuan started to weaken in February. You can see after hitting a high at around 6.5 to $1, it started to weaken in February and then dropped more than 1% in March. The PBOC said it will make the Chinese exchange rate more stable and step up prudent management of cross-border capital flows and guide market expectations. So after the sharp appreciation in the last 8 months until February, we expect the yuan to have some correction. It may depreciate against the US dollar. It may drop to around 6.65 to $1, and then the support will be around 6.5. So the upside resistance for yuan will be at 6.5. Yet there's a downside. There's some room downside. We are looking at a further depreciation to 6.65 as the US dollar is strengthening, and US Treasury bond yield going up, expectation of high inflation in the US. So all this will exert pressure, downward pressure on yuan in the near future. Okay, now let's look at the Q2 index targets. And last time, if you remember, we gave index targets for the 2021 and some ETF picks. We found out that most of the targets were actually hit in the first quarter in either February or March. Shanghai Composite Index, last time in my January presentation, we gave a target of 3720. And then we recommended investors to buy the CSOP A50 ETF, ticker 2822. We gave a target of 22.5. Now it has risen to more than $23, to about $23, because the Shanghai Composite Index hit a recent high of 3731, slightly above our target. So we hope investors who have bought CSOP A50 have already taken profit when the target was reached. So going forward, we expect a second quarter the index will move sideways after the sharp rally in January and February, and there's correction in March. We expect it will stabilize in the second quarter. We expect a range of 3,300 and 3,580. We expect the Shanghai Composite Index to trade between this range in the second quarter. So ETF picks, we have two ETF picks, CSOP A50 2822. Those who have sold, those who have taken profit on this ETF can buy back at $19, and the target is 21 Hong Kong dollars, about 10% upside. Stop loss, we'll recommend stop loss at 18 Hong Kong dollars. The other one that tracked the CSI 300, if you don't like the A50, you can choose the other ETF, the China Asset Management one, CSI 300, the ticker is 3188. Recommended buy price 60 Hong Kong dollars, target 66, 10% return, stop loss at 57 Hong Kong dollars. Okay, so Hang Seng, the Hang Seng Hang Seng Index has also surpassed our 29950 target, hitting 31183. There's an overshoot on our target this year. And the tracker fund that we recommended in my January seminar has also exceeded the target of 30.2 Hong Kong dollars target. So in the second quarter, we expect the Hang Seng Index to trade between 28,000 and 29,800. Currently, it has risen back to 28,900. So if in future any correction towards 28,000, it would be a good entry level, and we expect the upside target slightly below 30,000. ETF recommendation, the tracker fund, ticker code is 2800. Those who have sold above $30 can buy back at 28.50, and our target is 30 Hong Kong dollars. Stop loss recommended at 27.5. Okay, as for the Hang Seng Tech Index it has also exceeded our, it has overshot. It has risen to 11,001, the highest. Our target was 9,600, so it exceeded our target. And last time we recommended this CSOP Tech ETF 3033. It has also surpassed our $9.6 target. Now it has corrected to corrected to around 8,200, 8,300 points. So we recommended to buy back the CSOP Tech ETF 3033 at 8 Hong Kong dollars with a target of $9.30 and a stop loss at 7.4 Hong Kong dollars. We also recommended another tech ETF managed by iShares, which actually the expense ratio is lower than CSOP. So we recommended buy price of 17 Hong Kong dollars with a target of 19.50 and stop loss at $15.60. Okay. Now let's come to the stock pick part. This time we recommended a company that Singapore investors may be familiar with. You may have heard about this company, and that is Razer. The stock code is 1337. This is the logo, three-head snake logo. So Razer is a leading global brand for gamers and esports. Its ecosystem consists of hardware, software, and services designed and developed to integrate seamlessly and enhance personalized user experiences for gamers across different entertainment genres. It also offers payment services for youth, millennials, and Generation Z. Its services business comprises of Razer Gold and Razer FinTech. So it used to be a hardware manufacturer producing hardware for gamers who play PC games and also esports. But subsequently, it has transformed itself from just being a hardware company to also a software and services provider. It now is offering fintech services through its Razer Gold and Razer FinTech. Okay, these are some of the flagship hardware products from the company. For instance, the glasses for playing games, the Razer Enzu smart glasses for playing PC games, Razer Kraken V3X earphones to get a better better sound effect when playing games. This Razer Viper 8K cursor and a PC, more powerful PC for playing games, Razer Blade Pro 17, and the keyboard as well, Razer Huntsman V2 Analog. Okay. These are some of the key highlights for the financial year of the company ended December 31st, 2020. The company saw record high revenue of $1.2 billion. So it's the first time its revenue surpassed $1 billion with 48% year-on-year growth, driven by robust demand as well as market share gains for the hardware business and continued exponential growth of the services segment. The company's gross profit margin improved to 22.3%, driven by improving margins in the hardware segment and increased contribution of the higher margin services business to the group. The company finally turned profitable with GAAP net profit of $0.8 million, fueled by exceptional revenue growth and productivity improvements. And the company also saw very strong cash flow, cash inflow. Cash flow from operating activities turned positive to $152.6 $3.9 million US, driven by strong operating profits, efficient working capital management, and cash discipline. As at 31st December 2020, the company has a cash balance of over $600 million US, and the company has no debt, is debt free. So it's one of the strongest balance sheets in the industry. Okay, just now I mentioned the company now has ventured into fintech business through Razer Go and Razer Fintech. Razer Go is a global game digital entertainment payment service. Players can use it to buy virtual tools to play games. So the Razer Go recorded a more than 100% year-on-year increase in total payment volume, TPV, in 2020. As of December 31st, 2020, Razer Go recorded over 26 million registered users, representing 23.8% growth year-on-year. And it's very internationalized. Users from more than 130 countries can purchase Razer Go from more than 5 million channel touch points. Okay. As for Razer Fintech, it provides fintech services in emerging markets, primarily in Singapore. It's one of the leading offline tune line O2O, offline to online. Sorry, there's a hyphen there. Offline to online, O2O digital payments networks in Southeast Asia. Last year, Razer Fintech generated a TPV of $4.3 billion US, representing an increase of 104.4% year-on-year. In September last year, Razer Fintech announced a partnership with Funding Societies, the largest digital financing platform in Southeast Asia, to offer short-term business financing to its extensive merchant base. In December last year, Razer Fintech also announced a partnership with a Singapore-based Buy Now Pay Later (BNPL) service provider to offer Buy Now Pay Later services in Southeast Asia to merchants registered with its payment processing platform. I think you may have read the news that Razer has bid for a fintech, a virtual bank license in Singapore, but in the first round, it was not granted the license. But the management remained optimistic about obtaining the license in future if there are a second round of bidding. Okay, what will be the growth initiatives of the company going forward? One area is mobile cloud gaming. It has industry relationships with key players in the cloud gaming space, such as Microsoft's cloud gaming beta with Xbox Game Pass Ultimate and NVIDIA GeForce Now and Tencent Cloud. Another growth initiative will come from the esports. Razer will continue its efforts to popularize esports on a global basis. Now its brand reach extends to over 4 million fans, esports fans. Okay. The outlook of the global games market remain optimistic. According to Newzoo, the chart on the left is the number of global active gamers. So according to Newzoo, there were approximately 2.5 billion active gamers worldwide in 2019, which is expected to grow to 3.1 billion active gamers in 2023, with a compounded average growth rate of 4.7%. The chart on the right-hand side is the global games market in revenue. So the global games market generated $152.1 billion in revenue in 2019, 152.1 billion. It is expected to generate 196 billion in 2022, with a CAGR, compound average annual growth rate of 9%. Okay, this is the projection of its future revenue. Last year, as I mentioned just now, its revenue for the first time surpassed 1 billion, the $1 billion mark. So 2021, we expect the company's revenue to increase by more than 10% to 1.38 billion. 1.38 billion in 2021. And then 2022, it will further increase to 1.6 billion. Net profit, last year, it made a profit of JAP profit of $0.8 million. So this year, we expect its net profit to increase very rapidly to $38.68 million, and will further increase to grow to $82.6 million in 2022. So we'll see a quantum leap in the next 2 years, 2021 and 2022, in the company's net profits. Okay, our target price for the stock is 3.36 Hong Kong dollars. Actually, it has reached close to 3.3 earlier this year, and then its share price corrected to close to $2 in early March. Now, after the result announcement, because the results is better than expectation, its share price started to climb again. Currently has risen back to around 270. We recommended to buy at 255 Hong Kong dollars. Target price is 336 Hong Kong dollars. Stop loss is 2.25 Hong Kong dollars. Okay, so that is my presentation today. We have some time to answer the question of the audience. Okay, let's see what questions there are. Okay. Is high-tech ETF 3067, Tencent, JD, Xiaomi, Baba, Baidu, Kuaishou worth of buying at current price? What will be the target price? I think this, by answering this question, I will have answered a lot of people's question. Okay, that's a good question. 3067, just now we have given recommended buy price at $17. Let me see. Get back to my PowerPoint. Yeah. I forget the. Oh, here. Oh, sorry. 3067, yes, we recommended to buy at 17 Hong Kong dollars. Target price 19.5 and stop loss at 15.60. As for Tencent, we are still rather upbeat about the outlook of the company. The full year results is in line with expectation. So we recommend to buy, but its share price has rebounded a bit lately. So let me look at the price chart. 635. A good entry point will be 635 Hong Kong dollars. The near-term target will be 685. So there's a expected return of $50. If you manage to buy at 635, you may set a cut loss point at below $600. If it drops below $600 again, then we'll advise cut loss first, and the entry level would be 635. Okay, the second stock just now, JD 9618. Its share price has also dropped quite a lot recently. Compared to Alibaba, I think we favor Jingdong to Alibaba as it's facing less political headwind as compared to Alibaba. Currently, it's trading at 336.2 Hong Kong dollars. It has dropped to around 300, so it has rebounded 10%. We recommended to buy at 330, and then if it's for medium-term investment, you can put its stop loss, set the stop loss at 300, 10% stop loss. If you manage to buy at 330, the first target will be 360, $30, about 10% expected return. Okay, Xiaomi, they have announced that finally announced that they are going to produce electric vehicles, but that doesn't have a lot of stimulus on the share price. Doesn't have a big boost on the share price, as it has already been rumor and expected, so it has already priced in. But going forward, we are a bit we have reservation about Xiaomi this year, because last year it benefited from the loss of market share by two of its major competitors, Huawei and Apple. But this year, as Huawei started to produce handphones again, and it's sold the Honor brand to another owner, so the Honor brand will also launching new handphones to compete with Xiaomi. So we are a bit worried that Xiaomi will see a smaller market share, may see some loss in market share this year after the gain in market share last year. So if we will recommend to buy at 2450, the upside target will be around 2750. If one manages to buy at 2450, you can put the stop loss at $23. Alibaba, we still think there are too many uncertainties, the political headwinds that Alibaba and Ma Yun are facing. So we only expect the share price to trade sideways between 210 to 240, 210 and 240. So if you want to trade this range, you can buy at around 220 and take profit when the share price rise towards 240, and the stop loss would be you can place the stop loss at 210. If it drops below 210, you may better stop loss. Okay, Baidu 9888. I think its share price has dropped below the IPO price, 252 Hong Kong dollars. It's still below, despite the rebound lately. It's still below the IPO price. But the short-term catalyst, we don't expect a lot of short-term catalysts for Baidu. So we expect resistance around $235, $230 to $235. But it also shows support at the $200 level. So one may buy at 210. Get out at 230 to 235, and if drops below 200, then stop loss lah. Okay, Kuaishou rebounded more strongly. Not yet. It's Bilibili. Bilibili has rebounded quite strongly after the listing. So it has also formed a double bottom at 250. Now it's testing the resistance of the 10-day and 20-day moving average at 280, around 285. If it manages to rise to break out at the 285 resistance, it may be looking at 320. Okay, so one can buy at 270. And then the first stop is 300. If it manages to hold above 300, then you can set another higher target at 320. That's 320. Stop loss will be 260. Okay. JD Health. Okay, you bought JD Health at 150. It's dropped 24% since then. Any revision in the target price of 254? After the results, we did not have any revision. We did not revise the target price. We still have a target price of 254 after analyzing its full year results. So average down, your entry price 150. Now it's 114. I think you can average down. You can buy some more at around $110. So that will bring your average price down to 130. But to play safe, you need to set a stop loss for the shares that you are going to buy at 110. If it dropped below $99, the stop loss will be 99. Then we'll recommend stop loss on the second chunk of shares that you bought. The rebound target would be 130 to 135. Of course, you can, if you plan for long-term holding and are still a believer of our target price of 254, you can continue to hold the stock despite the share price rising to 130 in the near term. Okay. Top 3 stock picks for the China-Hong Kong market. Okay. I've not prepared for this. I think ETF lah. It's better to be more diversified. Just now we have already 2 ETF recommended: the Hang Seng Tech ETF, the Hang Seng the Tracker Fund, and a third stock pick would be Razer. Razer. After listening to my presentation, you may consider Razer. Okay, is bank, property, oil, and gaming stock worth of buying, like 1398, 688, 1928, 883? Among these 4 sectors, I will only recommend gaming stock in the second quarter, because for banks, there's no pleasant surprise, no surprise on the result announcement, and the valuation of most of the mainland banks now is trading at, I would say, fair value, neither undervalue nor overvalue. So I don't expect there's much upside to banking stocks. For property, you mentioned 688, China overseas land. So I presume you are talking about mainland property companies. There's still austerity measures being implemented to aiming to cool down the overheating property market in China. and also the three red line, the so-called three red line, to limit the leverage on some highly leverage, highly debt-laden companies will also exert pressure on those property companies. If you look at the price performance of 688 China Overseas Land, actually it's quite disappointing. Its share price has risen last week, in the first part of last week, and subsequently it fell back again. So there's not enough buying momentum for mainland property developers. If you want to buy, I think this year you have to look at a few things. First, those companies with a lower debt gearing. Secondly, those companies that still report good contracted sales. These are the two most important factors when considering mainland property companies. As for gaming stocks, we think there's a chance that the vaccine will enable more traveling, more opening of, the resumption of tourist arrival to Macau. Hopefully, this golden weekend is coming in May. So I think gaming stock, including 1928 MGM, is worth a bet in the second quarter. Oil stocks, I'm still not too sure about, because the strengthening US dollar may not be too favorable to oil prices. And then the virus, the pandemic in the Eurozone may also dampen demand for crude oil from a global perspective. Okay. Many investors rotated out of tech stocks to other sectors such as industrial and finance, but how are their valuations now? Is there still a lot of room for growth in those sectors versus tech sector? Industrial sector, I think some of the industrial companies, the valuation is quite rich at the moment. It depends on individual companies. I can't generalize, but some of the industrial companies with better results, they are already also priced in, so they are trading at a rather not cheap valuation. Finance, I think with the interest rate, inflation, and also rising interest rate may favor banking stocks. So just now I mentioned mainland banking stocks because of the slow growth. We are more upbeat on international or Hong Kong banking stocks, such as HSBC, Standard Chartered, or Hang Seng Bank and Bank of China, Hong Kong. Okay. What is my view on clean renewable energy sector? Is it a good time to enter now? What would be your suggestion stock to look to enter? Actually, the share price has gone up quite a lot, and now they're still under correction. I think some of the renewable energy companies, they are trading at rather low PEs in the past, but recently, because of this carbon, this euphoria over the energy preservation and this carbon concept, the share price has risen quite a lot, and the valuation now is not cheap. But one company I think is worth a look again. This is the company that I recommended in the past that really disappointed. I think many of you are, including myself. That is Everbright China. Why so? Because Everbright China is now only trading at single-digit PE, and the dividend yield is I think it's around 4%. Let me check. But one catalyst is the company has announced that it will apply for a listing in China A on the China A share market. So this would enable the company to in the past, what is limiting the company is the high gearing, because the company has a lot of projects on hand. They have secured a lot of new projects, but the problem with them is this is also becomes they becomes a victim of its own success. It obtains too many new projects, so the cash the need for funding. There's also a tremendous pressure on the company for funding needs. The company has a rights issue in the past, yet it still cannot meet the cash demand because of there are too many new projects to invest and to build. But with the expected return to A-share market, and also they are adopting a light asset model. So I think it should command a higher valuation. Now it's trading at a very undemanding valuation, 5 times historical PE, and yielding 5.7%. Both 5 times PE, more than 5% dividend yield. So this is actually a good company, but as I mentioned, has become a victim of its own success. So the valuation, it suffers in the valuation. But now I think its prospect will brighten as it plans to get a listing on the A-share market. Okay. What is your view on e-car and whose fintech services is used by Tencent? It's not exclusive, first of all, and the results, I think, not too impressive. The why share price continues falling after the result announcement? It's because the net profit increased by more than 4 times, increased 418% to 439 million yuan in 2020. Yet, more importantly, is the revenue only increased 1.5% to 2.29 billion yuan. So the dismal growth in revenue is makes investors worry investors, because this kind of company you expect for this kind of company, such as a SaaS company, even if you don't make profit, it does, investors are not too worried. What they are eyeing on is the revenue growth. So the revenue growth of the company last year was quite disappointing. The revenue only grew by 1.5%. That's why you can see the share price is still under pressure. Okay. What is your could you please share with us your latest take on Razer? Just now I have a very detailed presentation on Razer, and also the target price. Again, we have a target price of 3.36 Hong Kong dollars. Okay. Yum China, we're still holding the stock for our customers. Let me see. So I think the company is still on track. Its expansion is still on track with expansion, opening more stores in China. So we are still holding Yum China. Geely, now we recommend investors who are holding Geely to switch because of the not so smooth A-share listing plan. So, and also it has less noise than its competitors such as BYD and or Great Wall Motor. So we actually will recommend switching, selling Geely and switching to either BYD or Great Wall Motor. Okay. Which bank and insurance stocks will be your top picks and buy-in price? CITIC Bank, 998, CCB, China Construction Bank, ICBC, or China Pacific Insurance, Ping An, China Life. Thanks. Okay. For bank stocks, I will. My top pick is neither of these three. It is China Merchant Bank 3968, and the other is Postal Bank. 3968, we recommend buy entry level of now it's trading at 60.35. So wait if its share price correct to $57. You'll recommend buy price of $57 and target 63 to 65. Stop loss, if you manage to buy at 57, you may set the stop loss at 53. The other banking stock, mainland banking stocks that I favor is 1658 Postal Bank. It is actually the fifth largest state-owned banks besides the ICBC, CBC, and CCB, and Agricultural Bank, and BOC. But currently, its share price is forming a round top and is now under correction. So I think it's a good opportunity to buy at a lower price. 525, I would recommend a buy price of 5.25 Hong Kong dollars. Target $6. Stop loss at 490. Okay. As for insurance stocks, if you prefer Chinese insurance company, I still will pick Ping An 2318. But if you want to diversify, want a company with with an international profile, I will recommend AIA 1299. So Ping An recommended price buy price is 92.50 92.50. Target price is 99. It seems the $100 threshold is still strong resistance to a share price. So I will set the target price at 99. Buy price as 92.50. Stop loss at 88. Okay. As for 1299 AIA, the recommended buy price is now it's trading at 94.90. Is 92 91.5 to 92, 91.5 to 92. Target price 102. Or even if the operating environment brightens up, I'm not surprised to see share price to rise to 105, 105. But on a more conservative footing, you can look at take 102 as the target first. So $92. Stop loss is $87. $87. Okay. Okay, I'll take a few more questions then before ending the presentation. Yeah, we'll take questions from the other audience. What's your view of 788 China Tower? I always caution investors against China Tower because the company is on a growth path. You can see the last 2 years, the earnings of the company grows quite rapidly in comparison to the telco operators, in comparison to China Mobile and Unicom and China Telecom. However, the problem with the company is listed on a very, very rich valuation. I remember it used to trade at 80, 90 times historical PE. So after 2 years earnings growth, now it's still trading on 26 times historical PE. So now it's bringing it closer to the international peers in terms of valuation. But at 26 times historical PE, I don't see a lot of upside to the share price. So that's why you can see every time its share price when rising to 125 or 130, there's stiff resistance. And for a company with a good prospect, 5G, I think people believe that it is a major beneficiary from 5G. Yet, when a stock, when a company is trading on a when the valuation overshoots, becomes too pricey, it will end up the share price keep dropping. Now it's even below the IPO price. So it goes to show that when we pick stocks, don't just look at the company's prospect. When someone tells you, oh, the company has a very good prospect, yet you have to look at the valuation. If it's already priced in or over priced, then there's very little upside to the stock. Okay. Some of the questions are overlapping. Xiaomi, Alibaba, we have already gone through that. CCP, BOC, same questions. What's your view on? Okay, I think I'll take this question. View on Global X Autonomous EV electric vehicle ETF 9845. Its share price dropped from $20.32 to $14.93. I think it's actually more healthy because the share price of Tesla and also the NIO and 小鹏汽车、理想汽车 which has risen too much. So now a correction is actually is good for the future of the sector and also for the ETF. So personally, I still think the policy-wise, China now even Biden also is supportive to new energy cars or electric vehicles. So it has formed a double bottom at around $13.50. So I think one can buy at 14 to 14.50, and then the first target is $16. Stop loss 13.850. The recent double bottom 13.50. Okay. Okay. Let me see. Let me take two more questions. Okay. Meituan and Zhong'an, good entry now after recent consolidation. Okay, I think just now we have not covered Meituan and Zhong'an. Meituan, the results is quite dissatisfactory because of the loss in its new business. So its share price was hit after the result and announcement. But from the technical analysis point of view, its share price has seen support at 270. Now it's seen a strong rebound to $325. So after rebounding from 270, I think now $300 has become the near-term support. So I think the market has digested the results, the disappointing results that its new business has generated a higher than expected loss, and also the outlook is of the new business still facing a lot of uncertainties. But I think this is already priced in, and the market has digested this. So I expect a support at $300. One can buy at $300, and the upside target 365. So there will be a close to 10% expected return from 20% from 300 to 360 to 365. So you can use the recent low 270 as a stop loss. So if you buy at 300, unluckily it dropped below 270, you have to stop loss, cut loss, you have to cut loss, then the expected loss is around 10%. Okay, so this is the strategy we recommended. The other one, Meituan and Zhong'an. Zhong'an is is a difficult stock, I would say. Sometimes, if not because of Catherine Wood, share price may not see the kind of sharp rally in February and March. But whether the Catherine Wood can still have the kind of impact on the share price as in February and March, I'm doubtful. So I expect the share price to move sideways in the near term between $45 and $55. So there's a $10 expected trading range for Zhong'an, 45-55. So you can position your own strategy depending on whether you have the stock, you are holding a stock. If you are if you bought the stock at a relatively high price, you may have to consider cutting loss when it rises to close to 55, and then buy back at a lower level to average down. Okay. Okay, one last question. Okay, let me see which last question I would like to take. Okay, flat glass share price. I would like to take this question. Flat glass share price. If not for the solar glass, the euphoria over the solar glass, the prospect, the outlook for flat glass would be rather neutral, because the housing market is cooling down in China. So the demand for flat glass from the construction sector will be, you'll see a lower demand for flat glass because of a cooling down property market in China. Flat glass may benefit from the car market as the car market recovery continues. So automobile glass is made from flat glass, so flat glass will also benefit. But the point is, the rising price in the solar glass in the last 1 year or so will prompt a lot of the flat glass producers to convert their assembly lines of flat glass assembly lines, production lines, to produce solar glass. So this will reduce the capacity and also the future supply of flat glass. That's why you can see an example of 968 and 868, the two companies that are dealing with solar glass and flat glass. 968, this Xinyi, let me see. Xinyi Solar share price has corrected very sharply from about $23 to now is trading $14. So it's dropped more than 50%. Whereas the parent company, a producer of flat glass, the share price is holding up well. Wow, it's trading at almost record high, close to $26. That's because the belief that in future solar glass, because more conversion of flat glass assembly lines to produce solar glass, so the capacity will increase tremendously. Future supplies will also increase tremendously. That will bring down the price of solar glass. But for flat glass, because of the reason I mentioned just now, future supply will be reduced, and that will support the selling price of flat glass, and that will benefit the flat glass manufacturer. But the share price, but that also is already priced in. The share price is not by no means cheap at the moment. Okay. So thanks for your time, and I'm looking forward to my next presentation, probably in July this year. In between, I will have a Chinese seminar, probably in May next month. So we'll announce when the date when it's decided. Thank you very much, and wish you all a happy weekend.